The Statement of Financial Position. This video presents the main features of the Statement of Financial Position, otherwise known as the balance sheet. The Statement of Financial Position, which is also called the balance sheet, provides a picture of the company's financial position at a specific moment in time. More specifically, at the end of each accounting period. The Statement of Financial Position presents, on the one hand, an overview of the economic resources that the company controls, and, on the other hand, a list of sources of finance. These are the sources of funds that have been used to finance the company's resources. As a snapshot at a specific moment in time, the date of the Statement of Financial Position is quite important, as its content will change continuously. The Statement of Financial Position concludes an accounting period and will be used as the starting financial position of the company for the next period. Let's have a look at the economic resources. These are called assets and are always found on the left-hand side of the balance sheet. Assets can be conceived as a bundle of rights and not necessarily as physical or other objects. They represent future economic benefits for the company. They contain two broad categories, non-current and current assets. Non-current assets represent the company's long-term infrastructure needed to sustain its operations. Non-current commonly means that the resources will be used over a period of more than 1 year. The non-current assets can be broken down into 3 subcategories as follows. 1. Intangible assets without physical form. 2. Tangible assets. And 3. Long-term financial investments. Here are some examples. Licenses, software, brand names, and patents. Land, buildings and plants. Machinery and equipment. Vehicles. Shares held in other companies to support a strategic relationship. Current assets represent future economic benefits to be used or consumed within 1 year. These rotate in a short life cycle. They're constantly changing and are mainly generated by the company's operating activities. Current assets consist of inventory, trade receivables, cash and cash equivalents, and other items of which the future economic benefits will be consumed within 1 year. The sources of finance are listed on the right-hand side of the Statement of Financial Position, or balance sheet. 2 broad sources of finance can be distinguished. Those related to the owners, the equity, and those related to creditors, the liabilities. As providers of funds, both groups have interests in the company and hold claims against the company, but with different priority. It is very important to realize that the right-hand side of the balance sheet does not contain any money or physical objects. It is an abstract list of claims. Creditors have a priority claim on the assets. Should a company go out of business, the assets would be sold and the proceeds from the sale of the assets would be used first to satisfy the claims of the creditors. These claims have a fixed lifespan. Here are two examples. A claim from a bank that has been providing a long-term loan to the company, or a claim from a supplier of goods where the goods have not yet been paid for. These claims are called liabilities. Owners are said to have a residual claim against the company's assets. Their claim is called equity or owner's equity. The owner's equity has two origins. The first origin is the funds contributed or brought in by the shareholders. This is also called share capital. The second origin is profits earned by the company's profitable operations and not distributed as dividends to the shareholders. These retained profits stay within the company as investment for future growth. Thus, retained profits increase owners' equity. It stands to reason that the statement of financial position is also called the balance sheet, as the statement should always balance. This means that the sum of assets should always be equal to the sum of the sources of finance. The fact that assets and sources of finance must equal each other is not a coincidence, nor is it the result of good management. They're equal by definition. The fact that the two sides of the balance sheet are equal is commonly referred to as the balance sheet equation. This brings us to some basic maths. First, by definition, total assets equal the sum of owners' equity and liabilities. Subtracting the liabilities on both sides of the equation provides us with the following format. The difference between total assets and liabilities is commonly referred to as net assets and is, by definition, equal to owner's equity. As we've already seen, owner's equity comprises two basic components, share capital and retained profits. We can therefore reformulate the equation as follows. Net assets equals share capital plus retained profits. Be aware that any profit generated between the publication of two balance sheets will alter the balance sheet equation. When the company earns a profit, owner's equity will increase and, by definition, this will also increase net assets. This shows that the balance sheet and the statement of profit or loss are methodologically interdependent. The next video will present the statement of profit or loss and further examine this interdependency.